Hello, this is Ed O'Dowd of CAPIS. Welcome everyone to our CAPIS monthly research call. For everyone that knows or anybody new to the meeting, this is part of a monthly series we do at CAPIS here where we bring independent research content, various analysts that we have relationships with or that we come in contact with that we think would be helpful to share with our clients. Those cover technical analysis, macro, some fundamental analysis. Today, we're joined with Gustavo Cano of My Fundamental Research. Welcome, Gustavo. And
thank you, Ed. Thanks
sure
for having
thing.
me.
Absolutely. Gustavo, My Fundamental Research is basically a fintech company that connects advisors, wealth managers, connects them with investors and kind of a platform. Gustavo could certainly share some information about that. Gustavo worked with BBVA years ago, managing ultra high net worth portfolios, managed pension fund portfolios, and then years later worked at Banco Sabadell, and that's actually how I and CAPIS came to have a relationship with him. I covered him at Banco Sabadell in Miami for many years, where they traded equities, fixed income with us. And then now, years later, as I've kept in touch with Gustavo in the last few years, he's launched this platform and kind of gone independent. And we're excited for him. It's a great opportunity. But I've always enjoyed his insights over the years, be it things macro, be it his take on international markets, U.S. markets. And so I'm excited to have him today. I know you and I were talking about macro, and I know we've had some conversations even over COVID. I remember some conversations, good ones we had on inflation as it was going crazy. That seems to be somewhat tamed. I think, though, inflation's still a little bit more than the Fed would like. And, as we expected, there was no change in rates yesterday. And just wanted to get your take on that and anything you want to discuss that you think is good for our audience. Welcome.
No, of course. Thank you, Ed. And what I'll do, if that's okay, I'm gonna share my screen. I have some slides to support our view on the markets. So let me just share. Let me see if you can see it now. And so jumping, can you see it?
I can see the front page, turning complexity and clarity.
Okay, perfect. Yeah. So let's jump right into it. So we have two ways basically of looking at the world today, and particularly the US. One is the right-hand side, where we have a very strong economy. Almost, we're having increased rates from 0 to 550 basis points, and it seems that nothing's going on, nothing happens, and we still can manage it, kind of like a flying rug, where we're still mothering through and going okay. And then we can also look at it like it is on the left side, where yes, we do have a flying rug, but we put in a lot of things underneath, and some of them are not that pretty. The purpose of the call today is within the context of a very strong economy and good behavior. We're going to talk about all those things that we're putting under the rug. We're all professionals. There has to be a disclaimer in every presentation. I'm going to save you the pain of going through it, but that it is. Now let's move on. Let's get into the macro take. So the world has a debt problem, and particularly the US has a debt problem. We're growing our debt by 1 trillion every 100 days in this country. It took us 92 days from going from 32 trillion to 33, 106 days from going to 33 to 34, and we're approaching 35 trillion right now. So debt is growing strongly in this country. Now, not only is debt growing aggressively, is that the cost of that debt is also going up. That you're looking at the cost of debt interest payment as a percentage of GDP as per the CBO, the Congressional Budget Office. And we're now at about 2.5%, but we're rapidly approaching 4%. Part of the reason why that is occurring is that Janet Yellen, our treasurer, is probably the only CFO in the world that didn't extend durations to the zero interest rate policy. And she's now going to issue debt, long-term debt, at higher rates, and that's going to increase the overall cost of debt. And also the problem with that is that we have an increasing deficit because we have no fiscal discipline. Whether you are a Democrat or a Republican, what we've seen is that debt is going up. We have debt ceiling discussions every once in a while, and everything points toward upwards deficit, and therefore more debt, and therefore more expensive debt. And that seems to be the vicious cycle that we're confronting today. Now, here's the irony that we confronted. You're looking at a chart that depicts, and blue bars is the global debt, and the red line is the total debt over GDP, global debt over global GDP. And probably the only solution that we have at this point, lacking fiscal discipline, is inflation, which is exactly what we're fighting. And so the Fed wants inflation at 2%. But if you look at that chart, after the pandemic in 2021, we reached 360% of global GDP, debt over global GDP. And the only reason why the red line went down is because inflation on a global basis was in the high single digits. And therefore, the cost of the amount of debt was growing below the GDP growth, nominal GDP. So the only way we have to manage the high growth of debt and the high cost of debt is actually through inflation, which is exactly what we're fighting these days. Now, how's inflation doing? Well, in most of the developed world, in the upper, let's say in the mid part of the chart, inflation is in the 3-ish%, which is okay. I mean, it's not the 2% that the Fed wants, but it's actually pretty good, a pretty decent rate of inflation. And you don't. Russia, Turkey, Venezuela, and Argentina are special cases. And for the most part, that inflation is going down, but we don't know if we're getting into a trough or a local bottom or not. The thing is, we're cheating. CPI is a proxy of the inflation you feel in your pockets. And you know that if you take your wife's or your spouse's for dinner, it's going up, and it went up a lot, more than 3, 6, or 7%. And the cost of acquiring a new house is also going up. And so what you have in screen is the yellow line, which is the way we used to calculate CPI during the 80s. And that will tell us that our inflation today is in the high single digits, even after increasing rates 5%. The blue line is what the CPI, the new calculation, tells us today. And that's what it's taking us to 3-ish%. So it's not 3, the actual cost of living. The proxy we use to measure the cost of living, which is CPI, is telling us the way it's currently calculated, that is 3%. Now, part of the reason why it's 3% is the shelter effect, which is the owner's equivalent rent and the rent of primary residence, which are the darker lines, the thicker lines, sorry, orange and blue, are a softer measure or an average measure of the real cost of shelter, which is the thinner lines, which, as you can see, during 2022 and 23 went up almost to 18%, right? So that's impacting a lot, because that has a weight of 40% of core CPI. It has a huge impact on headline CPI. Now, we have headline, we have core, and now we have super core. And what's super core? You take core inflation and you take shelter, you take housing out, and you measure what's left. And that super core inflation is also ticking up. So, and part of the problem is that transportation. So I'm sure you've heard about the issues with the Houthi in the Suez Canal, and how ships now have to go, instead of going through the Suez Canal, they have to go around Africa. And also the drought in Panama, which doesn't allow ships to go through the Panama Canal. That's also increasing the cost of goods, and therefore it's mounting on inflation. So it's not necessarily demand driven, which is what the Fed wants to control. It's also supply driven, and that's the stickier part of inflation that we're seeing. We also have the base effect. As you can see, during 2022, we have higher month-to-month inflation rates, and therefore 2023 had easy comparisons to 22, and therefore inflation went down on a percentage basis because we had easier comparisons. We had tougher numbers on 2022, therefore 2023 was better. The problem we're confronting now in 24 is that 2023 was already low numbers, therefore our numbers have to really go down if we want to look good versus last year. So that's what we're having on April and May right now. And that's also going to give us the impression that inflation may be picking up. But what are the break-evens telling us? First of all, break-evens, if I may spend 2 seconds on it, is you take Treasury inflation protected securities, TIPS, you compare it with nominal bonds, You make the difference, and that will give you the expected inflation at different terms, 5-year, 10-year, and 20 years, which are the 3 lines that you see. You have 20 years of break-evens on screen. But if we zoom in, what you can see is that the 3 of them are ticking up, are trending up. Now, it's not worrisome. It's just a small trend, just probably 3 months. But it's significant in the point that the 3 of them are going up. It should be, the normal would be that the 5-year inflation is going up, and then the other ones are going down because they expect the Fed to intervene and therefore make a cycle. And at this point, the 3 of them are going up. Now, paraphrasing you two, inflation moved in mysterious waves, which means that you're looking at the 60s and 70s, where we had the last big inflation waves, and you see that there's 3 waves. The first one, which is the one similar to the one that we just passed, where we have probably a demand shock, whether it's due to monetary expansion or else, and then central banks intervene and lower inflation. And we're probably around that point where it says now around 72, where we control inflation. And the problem is that then central banks and investors in general think that inflation is under control, they're relaxed, and that's when the second wave comes in and kicks in. And as you look at the little orange chart on the top left, on the dark blue line was in the 70s, and the light blue line is today. So they look really similar. Now, I'm not predicting that we're going to have a second wave or a third wave. What I'm saying is that we could have an episode like this one, like we had in the past. And the problem is that most of the investors are positioned for the opposite. So 90% of investors, as per Bank of America survey, expect lower short-term rates, and 77% of investors expect lower inflation. No one is looking at the alternative, and they're positioned that way. Now, the other mandate of the Fed, aside from stability in prices, is unemployment. And if I may use the term, I think we're also cheating, at least cheating ourselves when it comes to unemployment. So first of all, we have very low unemployment right now, below 4%. But the quality of that unemployment is deteriorating. One is that the participation is lower. Some of the long-term employments that are becoming temporary employees. I'm sorry, and we have also some special situations, such as the number of retirees that are way above expected and way above average. So that's making us look too good for what we are really experiencing in the market. But not only that, but if you go into conference calls, earnings calls for corporations, you're starting to hear a lot the term operational efficiency, and almost on all the calls. And that's an euphemism for we need to cut headcount. Now we're in an electoral year, so we have no elections in November. Nobody's going to cut, nobody's going to lay off people massively before the elections. So I think one of the potential scenarios is that we got no layoffs from here to November. We got the elections, and then the month of end of November, beginning of December, and particularly end of 2025, we start seeing people getting laid off, simply because companies cannot withstand the cost of that haircut. Now, yesterday we had the Fed meeting. They decided to keep rates the way they are. They announced 3 potential cuts, which we'll talk about it a little bit. What happens with all these discussions about are we in a recession or not? So right now, economists think that the chances of a recession are low, so are actually lower than 40%. We do think we will have a recession. What is not clear is what's the definition of a recession anymore. It used to be two negative consecutive quarters of GDP. But we had that, and we didn't call it a recession because unemployment was very low. So now it's not clear, and we don't know exactly how it feels to be in a recession unless it's a deep recession. So we don't put that much attention on the term. We just look at numbers and see how the market and how the economy behaves under those conditions. Now, you have 2 charts in here, which is in the odds the market assigned to rate cuts by the Fed. On the left side, you have it at the end of February, when we thought that we were not going to have a cut in March, not going to have a cut in May, and there was a 60% chance of 65% chance of having a cut in June, and about 85% in July. Now, after the meeting yesterday, May is out of question. We're not going to have a cut in May, and we might have it in June and July. So now the Fed provided us the famous dots. Every dot is a voting member of the FOMC, and as the December meeting, 5 members said they saw 2 cuts for 2024. 6 members said 3 cuts, and 4 members said 4 cuts. Now, fast forward to March, and they're mostly in the camp of 3 cuts. Now, if we're going to have a cut in June and another one in July, July is the month where we're going to have the Republican National Convention and the Democratic National Convention, where the 2 candidates are going to be elected. After that, having a cut by the Fed could be interpreted as supportive of the current White House, president. So it's very unlikely that we're going to see a cut in the summer before the election, because it could be interpreted as not being independent. So the 3 cuts could happen as we stand today, June, July, and maybe November or December, assuming that the things are that there's nothing, an exogenous shock in between. Now, does that matter? Well, apparently it does, because according to also the Bank of America survey, 52% of investors, professional investors, think that it's a very important driver, or the most important driver for equity prices. And then 68% of investors think that it's the most important driver for bond prices. So that's why we pay a lot of attention, maybe too much attention, to what the Fed says and what the Fed does. Now, what does the past tell us about how the Fed behaves in terms of hikes and cuts? Well, on average, since 1968 hiking cycle, the Fed has taken 8 months from the last hike to the first cut. Now, those 8 months since the last hike will have been yesterday. So right on average, it will be 8 months. Now, if they cut in June, it will be 11 months. We're still okay. We're still within the average. So that is as expected. And this is important because the Fed doesn't like behavior that is outside the box, outside the past. They want to be somehow predictable, because they're very cognizant of the communication of what the market understands or not. So they know we are looking at these kind of charts, and they want to be in there. Now, the Fed is not the only central bank that is cutting. Actually, Bank of Canada, the Fed, the ECB, the Bank of England, the Royal Bank of Australia, they're all expected to cut this year. And we're going to get a lot of cuts this year, a lot of easing monetary policy. And maybe the only exception, or one of the few notable exceptions, is Japan, which recently increased rates from -10 to +10, so 20 basis points. But it's a complete different situation. So they're hiking just to be above above zero. So it's still a tremendous amount of liquidity and easiness in the central bank world. Now, how's that impacting equities? What you have on screen is 2 charts, 2 lines. One is the 2024 rate cut expectations, an inverted scale on the right, and then you have the Nasdaq. And as you can see, rates did matter up until January this year. And then, for whatever reason, maybe because the Magnificent Seven do not care about rate cuts, it's only the 493 stocks out of the S&P, or 93 on the Nasdaq are they don't really care about cuts. But as you can see, rate cut expectations went down, and the market still went up. And so we think that those 2 lines need to meet again, and there's 2 ways to doing that. One is either rate cuts expectations go up again, the red line goes to the green line, or upon realization that the rate cuts are not possible, either because inflation is picking up and they cannot do it, or something else, the green line starts to go into the red line. But we don't think that situation is sustainable. Now, what is the smart money doing, or thinking, or seeing? You have on the top chart, you have Berkshire Hathaway, the Warren Buffett vehicle, cash allocation, And right now they have about $180 billion in cash waiting to be invested. Even though he's a promoter of long-term investing, he's really good at timing. Not necessarily points in time, but when he doesn't find good things at a reasonable price, he starts to accumulate cash aggressively, and that's where we stand today. His favorite indicator, it's called the Buffett indicator, is the Wilshire 5000 as a percentage of US GDP. And if you look at it on the bottom side and the bottom of the page, you can see that yes, we are below the pandemic metrics, but we're way above the great financial crisis and the dot-com bubble. So we are elevated in terms of that indicator. So we are on the rich side of things, right? Now, there's also a new sheriff in town. For the first time since their appearance in our world, passive investments are higher in terms of volume than active. It's 53% of the AUMs for passive and 47% of active. And that means that they don't choose whether, they don't care if Apple or Nvidia are rich or are the valuation is correct. They simply buy whatever percentage is in the index. And so that typically amplifies movements on to the upside and movements to the downside. Because if you are a passive investor, you have to, excuse my French, suck it up when the market goes down. And that's also important for our current environment. And that also puts a lot of pressure on active managers too, which cannot hold cash because otherwise they will trail passive investments and they will get outflows. And people start saying, what am I paying 1.5% for an active manager that trails a passive manager? I'll just put on my 7 bips or 20 bips ETF that tracks the S&P or the NASDAQ, and I'm well served. On the upside, when you have the Federal Reserve printing money and having an uptrend with no volatility, that strategy works perfectly fine. The problem is when the tide turns, that doesn't work that well, and you really have to have a very strong stomach to withstand that. In terms of valuation, it's basically been multiple expansion, not that much from the earnings side, and that's also worrisome to some extent. Even the Magnificent Seven have some issues in terms of the ability to grow. So it's basically building, there's an air pocket between the pricing and the valuation and the actual support of the fundamentals of those prices. Now, there's also another issue, which is concentration. And there's concentration at 3 levels. There's concentration in the world within the US. So if you are a non-US investor and you've decided years ago that you didn't want to invest in the US, the opportunity cost that you bear was huge in terms of the allocation, in terms of the actual returns of the US equity market, and also in terms of the currency. Now, it looks you have almost 120 years of history, 124 actually, and you can see that it's somehow cyclical and there's a little bit of a reversion to the mean. Right now, it's 61% for the US equity market. There's a huge concentration on US equities. Now, within US equities, we have also a huge concentration where 10% of stocks account for 75% of movement, which is, I mean, it's actually closer to what we were on the crisis of the 29, right? So there's a huge level of concentration. And then there's a third level of concentration, which is on technology, Magnificent Seven. And the chart that you have on screen is staggering. What it's telling you is that the valuation, combined valuation of the Magnificent Seven is 64 times bigger than the US regional bank 50 stocks. So think about that for a second. So 7 stocks in one sector are 64 times more valuable than the 50 largest US regional banks. And I'll leave it there. Now, what we're saying about the disconnect is you have 2 of those Magnificent Seven, Microsoft and Apple. You have the price going up, and then you have the free cash flow going down. So it's not the only metric, it's just one metric, but it's telling you that there's a little bit of a disconnect between the price action and the fundamentals. And part of the explanation why these stocks are going up is because of buybacks. So funny thing is that prior to 1997, buybacks were prohibited because they were thought to be some sort of manipulation for the stock price. But then we started to say, well, but the dividends are now fiscally efficient. So we're better off, instead of paying a dividend, why don't we repurchase some shares, and we will give that money to investors, which are long-term investors, without the need to have the 20% or else withholding or taxes. The problem is now that some companies have been using that technique, which is I issue debt at very cheap rates, and then I get that cash, I buy back the stock, and then I push my stock up. And it also looks better from the bottom line. So let me give you a very simple example. If you make $100 on net income and you have 100 shares, you make $1 per share. If you issue a bond for $50 and buy 50 shares, let's say, then and you still make next year $100 in net income, now you have only 50 shares, so you make $2 per share. So that means you have with the same net income, you have a higher earnings per share. And that's a little bit of what's going on. And these guys have been using buybacks like there's no tomorrow. And if we exclude buybacks, the story will be much, much different. There's also a little bit of alchemy. What I mean by that is the difference between results using general accepted accounting principles and the ones that don't is huge. So right now, if companies they're using GAAP and companies that are not using GAAP, the difference between results expressed with non-GAAP principles and GAAP is about 30%. So that means there's a third of unexplained results in those books. So the pressure to perform is so big that if they stick to GAAP, they will not be able to give analysts and investors what they want. So let's get outside the norm and let's get outside GAAP and see if we can give them to the analysts, and they'll be happy about it. So that's also going on. So the quality of earnings is actually poorer than before. And also, as I mentioned before, because of the pressure from ETFs and all these things that we mentioned, active managers, U.S. equity mutual funds, have almost zero cash on their funds because they underperform if they do. So maybe they want to be prudent and hold some cash just in case there's a correction or there's an opportunity to buy at lower prices, but they cannot afford it. So they are fully invested, which is also this is also a leading indicator for potential corrections. And then when you have relatively high valuations and you look in the future, you guarantee yourself lower returns because you know that eventually those high valuations will turn and therefore returns will be lowered. So right now we're looking at a 10-year forecast returns for equity at about 3% per annum, which is on the low side of things. Now, are we in a bubble? Not really. So the valuations are demanding. Some companies might be in bubble territory, but if you look at averages, you look at the S&P 500, and you look at the where are certain valuations above trend or below trend, we're on the rich side of things, but we're not in a bubble. These metrics were above current ones a year and a half ago after the pandemic. So we're not in a bubble, or we feel we're not in a bubble. Now, there's also a picture that show you how close or how far, excuse me, are we from reality. The white line is the S&P. The red line is the Russell 2000, so more small caps. And what you see is that the small caps that are closer to reality are actually going down while the S&P has gone into new all-time highs. So if you ask me, I think the red line is closer to our economic reality than the white line. And the white line is actually influenced by 7 stocks that are global in nature, that have very specific businesses that are benefiting from this environment, and that they're being also benefited by the alchemy and their ability to push stocks up through buybacks. So that's a little bit of the overview. As a summary, before I turn it back to Ed, I would say that we have a growing debt problem. that we're not paying enough attention. We think the Fed will cut. The timing is tricky, so hopefully, or maybe June, July, and December. Equities are priced to perfection, and we're not in a perfect world, far from it. And we think we're at a tipping point. So any push in either direction will actually take us to very different scenarios. So Ed, with that, these are my prepared slides with prepared comments. I'll open up for questions or any further comments that you might have.
Sure, absolutely. You mentioned that chart you showed with the triple mountain of inflation, if you will. You showed we were in relationship to the probably around 1974, I think it was, give or take.
Yeah.
Yeah, that's it. 72, we'll say. So obviously the Fed has access to every chart data point, and even in comments that I've heard Powell over the last year or two, the fear they have is cutting too soon and inflation comes back. I mean, how do you square 3 potentially expected 25 bips cuts with something like this? Like if the Fed's biggest fear is inflation getting out of control again, wouldn't they be smarter to just stay the course and keep holding it put? Like, what do you think about that?
Yeah, but the thing is, so it's actually a question, and they're in a very uncomfortable position. So if they don't cut, they bear the risk of unemployment exploding, as I said, because they're also looking at the unemployment numbers and saying this is getting worse, and they see that companies are actually filing to lay off people. So they say we gotta ease some of these conditions. Remember also that most companies did in fact take advantage of the low rates, issuing long-term debt at very low rates. So they have very low cost of capital, and they're using the new proceeds, and they typically invested in treasury bills or time deposits or money markets at 5-ish. So they maybe have bonds issued at 2-ish, 3%, and now putting the money to work at 5%. So they have a nice gap there. Now, if they cut, they should help the economy. If they don't, if they don't cut, they will hurt the economy, and if they cut, they bear that risk. So I think that's why they at this point, seeing the inflation at 3% and knowing that it's not that much on the demand side, but it's more due to supply side, then there's nothing they can do on that respect. They're willing to cut. Now, if they see unemployment spiking up, they're going to cut more aggressively. If they see the market tanking 20%, they will cut more aggressively. But that's the risk, and I can assure you that they're looking at this chart as well.
Absolutely. If we have any questions, you can just put it into the chat and I'll read it to Gustavo. Well, another question is getting back to what are your end slides there on small caps versus, say, Magnificent Seven. You mentioned how a lot of the performance with the Magnificent Seven increasing earnings per share, stock buybacks. And maybe you said it and I missed it. What is your view, or do you have a view on from today going forward, performance of small to mid caps? I mean, a lot of the people on the call, clients of ours, certainly own more than the big seven. I mean, when can we expect, small caps to be a little bit more in favor, or even mid caps, or even smaller large caps below like that top 10, top 7 stocks?
So I think if the Fed starts to cut, then I think that's gasoline for small caps. That will help them. Now, it will also push blue chips higher probably, but small caps that are now toughened in a tougher environment because of high rates will be beneficial of that. So there could be a rotation. We've been waiting for that rotation for a while, but the rotation could be thanks to those cuts. Now, if we do have a recession, and that recession is bigger than expected, unless the Fed cuts very aggressively, small caps will suffer. But I think part of that is already in the price, and that's the difference between the red line and the white line. What they're saying is, well, we have a recession in the US, but the world still functions somehow. At least we have more levers that we can pull to kind of continue with our business. Whereby small caps, if you have a recession in the US and in whether it's the Midwest or if you're in a manufacturing sector, etc., unless you have lower cost of capital thanks to lower rates, that they're going to suffer. So I think there's going to be a rotation, and the Fed will actually trigger that. We think so. That's possibly the way we see that playing out.
Okay, great. One question was, you mentioned earlier, in 2020, the rate of acceleration of retirees had happened. I think a lot of people probably, what do you think, went home during COVID? People that were maybe close to retiring, people that were, say, 64, 63, and were like, you know what, I'm done. I've been home for a year, working from home. I don't want to go back to. Is that what's going on here? What do you think?
Yeah. There's part of it, and there's so if you live in a big city, so one of the things, I mean, we can talk for hours, but one of the things, the phenomena that happened after the pandemic is that there's huge migration from high taxes to low taxes states. So Tennessee, Texas, Florida, kind of thing. And then once you lower your cost of living, because maybe you abandon high tax environment and you have enough of a nest egg, or maybe you sold your house at a high prices, and then you're saying, you know what, I might not want to work, as opposed to commuting or simply working from home. And that's also an interesting dynamic, because as these people retire, and as less people go to the office, you have the other phenomenon, which is what happens to that office space that is highly leveraged, so 65 typically % of the value of the building, and who owns those loans, which are typically on the bank's bellies. So the dynamic between unemployment, working from home, retirement, commercial real estate, in particular the office, and then the financial system, and then goes back to the Fed, it's also an interesting dynamic that we're looking at. So yes, there's a lot of people that are working from home still. There are a lot of people that decided that maybe if we lower our costs, we can stop working and enjoy life a little bit more. And there's also the problems because of that related to commercial real estate. So it's an incredible dynamic that we're watching right now.
Okay. All right. That was good. Any more questions? Please put them in the chat. Gustavo, thank you so much. I think we're probably about ready to wrap here. Really appreciated having you on the call today. And for any of our clients that would like a recording of the call or any of the slides, I think you mentioned you'd be willing to share the slides if any of our clients requested it.
Absolutely. Yeah, not a problem.
Okay, great. So if you want slides in the presentation, just reach out to your sales rep or whoever invited you to the call, and we'll be able to get that to you. Next month we'll have another call. I don't know exactly who the presenter is or the research guest appearer will be, but it'll be right around the third Thursday of April. So we'll reach back to you on that. Gustavo, thank you so much for joining us today.
Thanks for having me. It's a true pleasure.
Absolutely. And thank you to all of our clients and friends that joined us today, and we'll talk to you soon. Have a great day. Bye-bye.